Welcome back to the Life License Qualification Program video series presented by Business Career College. Again, my name is Jason Watt, and what we're going to talk about for the next few minutes is the riders and benefits that we can attach to life insurance policies. Now we're going to look at a series of riders here. We're going to look at about 10 different riders, and we're going to look at how each of them would fit into a life insurance policy. There are a few things in general that we should know about riders before we look at the details of the particular riders. So most riders are designed in such a way that they will provide some additional benefits, that if something specific happens to the life insured, that there will be some opportunity for some additional benefits to be received by the beneficiaries or sometimes by the life insured even while still living. These do carry an additional cost. They have additional features, they have additional items that make them attractive, and as a result, there will be some additional costs that we will attach to the policy as a result of adding a rider. Because of that, it's important to understand what the riders do. We don't want to add riders randomly just because it sounds like a good idea. We want to make sure that we understand exactly why somebody should acquire a certain rider, why somebody should be asked to pay the additional price associated with adding a rider on to a life insurance policy. In addition to understanding how the riders work, we should understand their particular limitations. We'll see that as we go through some of them, that they can provide some fairly useful benefits, but we want to make sure we understand exactly when they would or would not pay their benefits. Now, we usually talk about riders as being good things, but sometimes we would add a rider or waiver onto a policy designed to restrict coverage. Although that's fairly rare with life insurance, with disability insurance, as an example, we might add a rider specifically designed to exclude a certain type of risk. Not that common, like I say, with life insurance. Generally, where you have an unusual risk with life insurance, the result is either to decline coverage or to issue the coverage with a higher premium attached. But you will occasionally find a situation with life insurance where a specific circumstance could arise that might result in a non-payment of benefits. Maybe the most common example of that, and this is not all that common with life insurance, but maybe the most common example of that would be where we have a potential life insured who engages in a dangerous hobby. Maybe they do stunt flying, for example, and what might happen there is we might have a particular rider attached to the policy that would include an exclusion for their stunt flying. So on that note, let's look at the kind of conventional range of riders that are available. Now, not every insurance company offers these riders, and not every type of policy offers these riders. You'll find some insurers that will only offer certain of these riders with their permanent insurance products. Some of them only make sense with permanent insurance products. You'll find some of these riders that are only offered by certain insurers. Not every insurance company offers living benefits riders as part of its life insurance offerings, for example. So when we look at these riders, these are the ones that are most likely to be tested, but you may find when you're out in the industry later on that there is a broad selection or maybe a narrower selection of riders than what we see here. Understanding the concepts that we go through here, I believe, will allow you to understand whatever other riders you might see when you're out in the industry. So the first rider we'll look at is guaranteed insurability benefit. And guaranteed insurability benefit, it's kind of a neat idea. It is also very likely to be tested. I will be surprised if on your exams you don't see some exam questions specifically expecting you to know when guaranteed insurability benefit would apply. So I like to look at guaranteed insurability benefit as purchased on the life of a child. It's probably when it's the most useful. There are some limitations to purchasing it later on in life that make it less attractive. So let's have a look at a parent or a couple of parents, whatever, who buy insurance on the life of their child, let's say at age 3. Now, at age 3, this child's not going to need a ton of life insurance. It's not practical. Maybe you're only buying insurance at this point to build up some cash value so the child can borrow against it later on. You're maybe buying insurance at this point because you want to guarantee that the child's going to have some insurance later on in life so that if something does go wrong, that they're still going to have some insurance. Maybe you're buying some insurance right now for a legitimate need. It's kind of a sad situation. I don't like to think about it too much. I have kids myself. But maybe you're buying insurance at this point because you recognize that if something happens to the child, that it would be nice if the parents had a little bit of cash to help deal with that. But let's say that we decide to buy insurance on this child's life. We're not going to buy a whole ton. Maybe we buy just a nice, simple little $50,000 life insurance policy. I don't care if it's universal life insurance or whole life insurance or term insurance, although it's fairly rare to see term insurance purchased on the life of a child. The reality is that the cost of a universal life or whole life insurance policy at this age is so low that there's really no reason not to go to those permanent insurance products. Now, if we can use a timeline here, it's likely that between age 3 and age 18, this child's need for insurance is not going to change very much. Probably at age 18, $50,000 is still enough coverage. But the parents, when they acquired the policy, they said, what if $50,000 is not always enough coverage for the child? And realistically, when we think about a mortgage and financial obligations and a spouse and kids,